For analysis, I want to bring in Jim Tankersley, economic policy correspondent for The Washington Post, and in New York, CNN global economic analyst Rana Foroohar. Rana, I'm going to start with you. I think the first thing people are asking themselves when they hear this proposal from the president is, what does this mean to me? What does this mean for my mortgage?
Well, it depends on what legislation comes out of Congress. Right now, the federal government and state governments together implicitly or explicitly back about 80 to 90% of all mortgages in this country. So if you think about a healthy housing market as being something that doesn't require government support, we're a long way from there. So the idea of slowly moving the mortgage market away from being underpinned by the government is a smart idea. But you still need banks to lend, and that's been the problem. Throughout the crisis and recovery, banks haven't been making enough loans to real people. So far, a lot of the housing recovery has been investor-led. It's been led by people that have cash on hand and can put down cash for mortgages. People that actually need a 30-year mortgage have had a tough time getting one. And what the president wants to do is ensure whatever legislation is passed gets the government out of the housing market while still making enough provisions that people can get those 30-year mortgages that they need.
And Jim, do you think that these steps for getting the government out of the housing market, not entirely, but to a large degree, will help insulate taxpayers, help protect us?
Well, this is the big question, because what it leaves is still a lot of liability for the government if there's an enormous housing crash like the one we saw last time. Because basically what the government would do is it would ensure, like the FDIC does with the bank deposits, it would ensure that your mortgage is going to be okay. So if there's a big crash, you could have big liabilities again for taxpayers. But the idea, the hope, is that that won't happen and that the cost of the insurance will cover any future liabilities.
Rana, let's talk about the timing of this. Do you think the president's making this move too soon?
Well, I think that, you know, he's within a few months of where he should have been. I probably would have liked to have seen another 2 or 3 months of strong housing data. The last couple months have shown that we are starting to get a little more credit flowing into the system. But one thing that we should remember, you know, we have this idea in this country that you need a housing recovery in order to get a healthy economy. Actually, you need a healthy economy. You need people to have jobs in order to get mortgages. So really the underlying recovery has to keep continuing in order for unemployment to come down and ultimately wages to go up, which will help people improve their balance sheets. And that's what's going to give them a better credit picture and get them those mortgages.
And Jim, for a first-time home buyer out there, somebody who's shopping around, what does this mean?
Well, the first thing is it's been harder to get a mortgage if you are a first-time buyer with not great credit. And the idea here might be that the opening up of the private market will allow more people with maybe a little less of a good credit score to get, you know, their first loan. The other thing that they should be watching, potential first-time home buyers, is interest rates, which have gone up a little bit recently and are probably going to go up again because of some Federal Reserve decisions coming down the pike.
All right, fantastic. Rana Foroohar and Jim Tankersley, thank you so much. Appreciate it.